Good morning, everyone. Tim Nyland here. Today is Wednesday, February 3rd, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market. If you have a topic you'd like me to explore in a future video, please leave a comment below. You can check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of Zacks Pro platforms. And don't forget to hit the subscribe button below to make sure you never miss any of our future calls. Today, we're going to be following up with more macro strategy off the back of last week's call on the airline industry. And what we're going to do is we're going to take a look at the earnings certain portfolio family and specifically take a look at what's happening with the tilt portfolio. And keep in mind that the tilt portfolio is one of the strategic sleeves that we use to gain additional exposure to upside capture in the broader market. So it's a composite of 6 stocks: Amazon, Facebook, Google, Microsoft, Apple, and Adobe. And every once in a while, we see this particular group of stocks start consolidating. And you can see throughout history, it normally lasts for 4 to 6 months. And then that particular group continues to rise. This is a really, really good opportunity to discuss exactly what's going on here, what the catalysts are relative to what's happening with the broader S&P 5, the rest of the cyclical type moves that have taken place in the market with regard to financials and energy. So we're going to kind of do a full wrap on everything that's more or less taken place from a macro strategy perspective. And the first thing that I want to bring everyone's attention to, and specifically those users of the Zacks research system, is that when we're in the middle of reporting season and we're looking at composites, we have to remember that there's going to be noise in here in terms of the actual estimates and even the actual period. Once we start calculating this number, we have clipping rules that take hold. And keep in mind that Google and Facebook, this is actually a pre-recording, so this is Tuesday afternoon. Google and it's actually Google and Amazon haven't reported yet. They're due out this afternoon. So when we get those partial reporters in here, some of these numbers will actually get a little bit of noise until they iron themselves out. So this growth trajectory we're actually looking at is, between 20% here all the way out to about 27% in 2023. And you can see that even though we have this, what we call this multiple consolidation, if you will, or valuation catch-up, where we actually have a declining PE multiple against a backdrop of continued rising earnings. That's obviously due to a flat line in price, and we're going to actually dive into this a little bit deeper. One of the things I want to do is just very quickly reintroduce the earnings certain portfolio and just kind of show some of the noise that we're seeing out here as well. Again, those estimates being that we're in the middle of earnings season, FY3 shifts into FY2, FY2 shifts into FY1, and we do get a little bit of noise. Long-term trend on the earnings certain portfolio, again, tends to run right around 11% over the last 25 plus years in earnings growth. And if we compare that to the S&P 500, that trend's normally around 7% or so. And you can see that with regard to the S&P 500, again, coming out of that COVID-induced recession, we talk about value rotations, we talk about growth performing well, and you'll see here in a minute that this value rotation, again, I've said it before, I'll say it again, it actually started well back in March, April, at the very bottom of the COVID-induced sell-off. And you can see that we're still working our way through the trough in the S&P 500, 16% decline in earnings forecast for this year. 2021, 30%, 2022 to 15%. And again, we've got some noise in these numbers. We need to wait another couple of weeks for all the earners for Q4 to report, and then these numbers will smooth themselves out. But again, against the backdrop of what we're talking about today is this valuation stretch, right? The fact that we haven't gotten through the trough yet, and we are at obviously record highs in the broader market, and we're pricing in earnings that we expect a year and even in some cases 2+ years out. And so that's what we're going to dive into and discuss a little bit more today. With regards to the Admiral portfolio, again, a little bit of consolidation. We're actually seeing that right now with the earnings certain Core 75 as well, the original 75 stock portfolio. Keep in mind that the Admiral portfolio was the portfolio that we used. We stripped out all the companies that were that were subject to any sort of reopening phenomenon in the earnings certain core 75. There was 45 of those companies. If we strip those out, you'll end up with 30. Those companies were able to grow their earnings right through the COVID-induced recession. And you can see the performance of that underlying earnings for the past, I believe this is a 20-year chart. So again, this group of 30 stocks, literally unstoppable earnings growth, and that obviously provides massive amounts of downside protection for us during any recession. And you can see that here relative to the S&P 5. Again, keep in mind there's a lot of noise out here. This particular group of 30 companies also tends to trend its growth rate right around 11% long term. So we'll be looking forward to that. So let's go ahead and take a look at what is happening with the financial sector. So what I like to use to look at the financial sector, we'll start with the market-weighted composite. And the financial sector itself, the reason this is important is we've literally hit an inflection point with financials, right? So we haven't, again, worked through the trough. And you'll notice that financials currently priced as a basket, and keep in mind this is market-weighted, just like the S&P 500, the broader index. So we're going to be heavily weighting this group of companies towards those money center banks like JP Morgan, Bank of America, Wells Fargo, those types. And you can see that we're already back to pre-COVID levels in terms of price, and earnings are still at the trough. So what that tells us is that there's obviously a lot of optimism baked in here for an increase in the slope in the yield curve, and actually overall just a general increase in interest rates over time. And the idea is, how much? And it appears as though if we look at valuations pre-COVID, we're looking at earnings that are roughly, a year, maybe just a little bit more than a year out at current valuations. But where it gets interesting is if we remove the market-weighted composite and actually put in the equal-weighted composite. So now we're going to remove the cap bias, and you're going to see a very different picture emerge. And this is primarily being driven by those smaller regional banks. And a lot of those are my favorites that I talked about in the fall of last year in previous webinars that have really been driving this rotation into financials. What I want everyone to see is that there was obviously huge call for value rotation specifically into financials. Right here is when we got our first COVID vaccine results that were positive, and you can see what's happened to this group of stocks since. But this recovery and this rotation actually started way back here in March, okay, at literally the height of the COVID pandemic and induced sell-off. And you can see that with this group as well, we're still working our way through the earnings trough, and we've got a long way to go to come out of this to actually justify this valuation. So how far ahead are we? Again, we're looking at a year and a half forward on earnings. A year forward is very, very normal. And when we're working through troughs for cyclicals, it's very common to see 1 to 2 years forward. So this is what I would consider very normal price action for a cyclical group of companies such as the financials. The key takeaway here is this tremendous outperformance by the smaller cap names in the S&P 500. That's the key takeaway. So again, comparing that equal weighted composite to the market weighted composite, you could see a huge difference. So the mega cap names not performing nearly as well as those smaller cap names. Again, just some strategy notes for you. We can do the same thing with the energy sector. The interesting thing about the energy sector, I'd urge everyone to listen to last week's webinar. This is almost a mirror image of what's going on in the airline industry. And the bet right now on that the buy side is making on this particular rebound is the level of recovery in the actual underlying crude oil prices. So the idea is, how deep is this trough going to be? Keep in mind, we're still working to the bottom of the trough. We haven't hit it yet. And then how wide is this going to be? Note that the sell side is forecast more of a V-shaped recovery. And we actually have a valuation model tool that we could use to actually look at whether the buy side has actually put a bid to valuation in relative to it being more of a U-shaped recovery or a V-shaped recovery. And we can certainly do that in a future session. We're not going to do that today. But that's the bet, right? The bet is we're making this leap of faith And we're basically betting that this rebound is going to take place. We know it will take place, but the idea is, what is it going to look like? Is it going to be U-shaped? Is it going to be W-shaped? Are we going to have some sort of resurgence with some COVID variant that's going to cause this to perhaps tick up and then tick down again? We don't know. And so as a strategist, that is what we look at when we look at these cyclical troughs. Again, how deep and how wide is this earnings trough going to be? Now, when we look at this from a market-weighted perspective, you'll see that it looks very similar. So not a whole lot of cap bias going on in the energy sector. If you look at individual names like Schlumberger, you'll see that it has this very, very similar price trajectory. In other words, that downhill trend all the way from 2014, and you can see this slope and earnings, the downward slope, and you can see that recovery for Schlumberger looks a little bit different than the broader energy sector. So in this particular group of companies, you really need to lift the hood, roll up your sleeves, and kind of dive in and look at individual names because they're all going to have a little bit different trajectory on the recovery depending upon what line of business they're in. But overall, this is really what we're wrestling. So the idea is, as strategists, where do we go from here? We have introduced three concepts today. We've introduced the concept of the cyclical rotation into energy names and what that looks like. We've introduced the concept of the cyclical rotation into financials and what that has looked like. And the other thing that we've introduced is what's going on with our tilt portfolio that's a member of the earnings certain family, and this flatlining, if you will, of the price. In other words, we've got a group of rock solid companies. Keep in mind, Apple, Facebook, many of these companies have already reported. They've reported absolutely spectacular numbers and still no upward trajectory, okay? But the idea is that will come because we have year-over-year forecast growth in earnings that are literally forecast to be 20 to 27% across the board for the next 3 years. And keep in mind, we're in earnings season again. These numbers have a little bit of noise as these figures down here are shifting. Okay, so we're going to look at what's driving this right here. And this is going to be really, really important for us going forward. With regard to cyclicals, though, before we look at the driver of what's happening here with the tilt portfolios for the cyclicals, we just had a very, very important number announced on Monday of this week. And we need to take a look at the impact of that information. And specifically, it is the ISM manufacturing number. So for those of you that have been on my strategy calls, you'll know that this is my favorite gauge of manufacturing, as is the actual Federal Reserve, keeps a really close eye on this number. Anything above 50 is expansionary, anything below 50 is contractionary. And if you overlay the Fed action, tightening, loosening through Fed stimulus, through rate cuts, rate increases, you'll see that it more or less mirrors this ISM manufacturing, specifically the Purchasing Managers Index. And yesterday, we just got a declining read on the PMI that was actually revised off of a downward December number of 60.5. And to have one revision down is not a big deal. What we want to look for is cyclical trend in downward revision. So again, my warning has been for months on end as we've been doing these webinars that ISM is cyclical, and we need to make sure that we don't get several months in a row where this continues to trend down, because the closer we get to 50, obviously the closer we get to contraction. Not saying we're going to get there, but you can see that this number is cyclical. Now, when we spoke in terms of the energy sector and the financial sector, I want to make sure that everybody understands this. Right? Our recovery started with both the ISM Manufacturing Index, Purchasing Managers Index, hitting bottom on 430, and specifically hitting bottom on 430 for the Services Index in the bottom panel below. And you can see that once we hit about 50, which is going to be right around the June timeframe, is when you would expect that cyclical breakout. As a matter of fact, any time during this uptrend. So if we go back to the price and earnings chart and we overlay this, We could do it against the financials. We could do it against the energies. It really doesn't matter. We'll take the financials, for instance. You can see that price bottomed out on 331, and we started really accelerating about the time those ISM numbers started to turn, okay? And then we troughed a little bit, just flattened out, and then once the COVID vaccines hit, everything started taking off. So this rotation to value that everybody continues to keep talking about, it's not a rotation to value. This has been going on ever since the bottom of the COVID crisis, okay? So again, can't stress the importance of the ISM numbers enough. I set up mine through the economic charts. You literally just come in here and just create a new 1 to 4 panel, put the manufacturing index on the top, put the services index on the bottom, and you've got just an excellent gauge for being able to time, cyclical rollovers as well as cyclical recoveries. Okay. So next thing I want to do is look at this particular chart again of the tilts, and I want to talk about the real cause of what's going on here. It's also a fairly substantial driver of the multiple contraction that we're seeing going on in the S&P 500. Again, the S&P 500 actually playing a little bit of a valuation catch-up as of late. You can see a little bit of flatlining here relative to forecast growth. And you can see that the rollover in the earnings certain portfolio as well, again, playing catch-up. So there's one common theme to all of this, and it's interest rates, okay? We all have heard that interest rates have been on the rise, but from a strategist perspective, we need to be able to quantify what this means. And I have a chart that I love to use for that, and we'll go ahead and get started with the S&P 500 first. And I actually have it created here in my 1 to 4 panel menu. We have it as a default view for everyone. If you do it this way, I would recommend that you make one change, and I'll show you what that is here in just a minute. But it is a 30-10 Treasury spread analysis view here. I'm going to go ahead and show it as the one that I created, the 32-10 Treasury spread, but I actually add the PEF12M at the bottom, and you'll see why. Okay. So the important part of this particular chart is the fact that in order for financials to recover at the rate at which the current valuations support, we need to continue to see this 30 to 10-year Treasury spread continue to rise. Okay, notice that it's been on the rise literally since Q2, since about right here, through Q3, Q4, and even into Q1 of this year, it's still rising. This is a really, really good sign for financials, and this needs to continue. And notice that spread has continued even despite the 30-year actually flatlining. The spread has actually increased because the 10-year has actually declined against the 30-year. Okay, and this is important. So it's really important to understand what the drivers are behind the spread, right? Ideally, we're going to see all of these rates kind of rising in lockstep together, and the 30-year actually continuing to accelerate away from the 10-year. That's kind of the ideal scenario. But what I want everybody to see is this PEF12M, in this case for the S&P 500, right? You can see it right here. That's where the bottom panel chart is. And I'll go ahead and show you where the trouble began. The trouble began right in here, okay, where we hit all-time record lows on the 10-year of about 0.55. And you'll see that from this point forward, we've literally doubled, and I mean doubled, the 10-year Treasury yield. And so this is obviously going to put pressure on the PE multiples for the broader market. And again, so this happened in literally, August 5th, okay, and we hit peak valuations, not only for the S&P 500 in terms of multiple, but also for the tilt sector, or I should say the tilt basket of securities for the earnings certain portfolio. That all happened in lockstep, and you can see that we've had more or less a declining PE multiple. And this is normal, multiple contraction against this backstop of increased rates. The real trouble we got into was this velocity of rate change here. And you can see that even though we had a PE multiple recovery, you can see that the PE multiple then again nosedive for the S&P 500 because of the velocity of this interest rate change right here. I think this really scared the death out of people, thinking we were going to have some sort of a taper tantrum again. And the idea is that we've basically been sliding on the 10-year back down to more of a normalized rate now. So again, to the extent this trend can continue, we may actually see this forward multiple stabilize out, maybe increase again. So this is kind of how you read the tea leaves with spreads and what's going on with yields. But keep in mind, the velocity of rate change is just as important as the overall trend in rate change. When you get these massive, massive moves, it can really, really shake markets. And if we look at what's going on with the tilt basket, the earnings certain portfolio tilts, you can see this is exactly what happened as well. So we hit peak PE multiples here back at the end of August, again, off the backstop of us hitting literally a 0.55 Treasury on the 7th. Those stocks continued to rise. We all know what was going on in the option markets then, and then obviously we've had a PE multiple contraction. This PE multiple contraction, some of it was caused by a decline in price, but a lot of it is just being driven by the fact that earnings are catching up to price. And the interesting thing is that we've got this period now where we've got this declining trend in the 10-year, and you can see that we've actually had these mega cap tech stocks play a little bit of a valuation catch-up. And that's really the theme of this call, is to remind everyone that if we go back and look at the charts here, the struggle going forward, it's going to be a power struggle, okay, for not only the broader market, but for the tilt portfolio specifically, anything that's higher growth. The idea is the underlying corporate earnings are going to need to more or less outgrow the velocity or the change in rates, specifically the 10-year. And we have equity risk premium that can absorb some of this rate change, but equity risk premium has been driven down to record lows just like the 10-year itself. So there's not a whole lot of room in here. So we are going to need to keep our eyes on the trajectory of these growth rates relative to our current valuations and relative to those change in the underlying 10-year Treasury yields. So what's going to end up happening is, I like to compare this scenario here to a coiled spring, and I'll go ahead and hide this data so that's not showing anymore. So the idea is this spring has been coiling now for almost 4 or 5 months, right? So we go back to August now. It's 1st of February, so call it 5 months. And the idea is if the 10-year goes down again against this backdrop of a 20% increase in earnings, obviously we're going to get a multiple expansion out of that. If the 10-year stays stable at current levels and we have a 20-year or 20% increase in earnings growth, then we're going to get this more or less trending in parallel. But if the 10-year continues to rise, okay, against a 20% plus growth rate, this multiple is going to expand or contract relative to the velocity of that rate change in the underlying rates of the 10-year. So just kind of keep that in mind. We've got 3 different scenarios that can play out here. The rate change, if it happens to increase in its velocity and rates make a sudden jump higher and continue to trend higher, it is possible that the tilt portfolio and any high growth portfolio can continue to see a multiple contraction. But ultimately, once rates stabilize, these high levels of growth will allow that earnings to catch up, and that's going to be the driver to continue to push prices higher. So again, rather than try to time the market and play with the financials and trying to determine where the actual slope of the yield curve is going to be, again, on an equal weighted basis, the financials look a lot different than on a market cap weighted basis. So keep that in mind. There's still probably value left in this group, but again, that is going to depend on your outlook on interest rates in general and the slope of that yield curve. And so keep that in mind, that when you're investing in the financials group, when you're investing in energy, you're participating in a market timing function. And when you're invested in the earnings certain portfolio itself, along with the tilts, it's not about market timing. It's more an effort of patience we've planted the seeds of growth, and you can see that we are going to get periods of multiple contraction. You're going to get periods of multiple expansion, and a lot of those are going to be determined by rates. But overall, you have a solid growth portfolio of underlying corporate earnings that grow at 11% versus the S&P 500 7%. And specifically, the tilt portfolio itself, affording you that beta of 1.08 against a backdrop of 20+% earnings growth. It gives you a really nice exposure to the upside capture on the broader market. And keep in mind, when we're looking at the earnings certain portfolio and the earnings certain Admiral, we're looking at betas of literally 0.8 for the broader earnings certain, and then the Admiral is literally a 0.68. So very, very defensive in nature, and it's just incredible that we can have a defensive portfolio like that that can afford us literally 50% higher underlying corporate earnings growth over the past 20 to 25 years relative to the market. So keep your bet on the growth side. We don't have to worry about the timing of the market. And for any of the tactical sleeves that you might be managing, obviously getting some exposure to financials and energies and other parts of the cyclical market is a good idea. That's all I had for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or requests, please leave a comment below or feel free to email me at tnyland@zacks.com. That's T as in Tim, Nyland, Nyland @zacks.com. You can also follow me on social media. I'm on LinkedIn, and my Twitter handle is @TimNyland. If you're interested in getting started using advisor tools or the Zacks research system, or looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com or at ZRS@zacks.com. Thank you very much for watching, and I'll talk to you next week.